Well, as we were saying before the break, it has been a busy week for bank earnings in this country, including National Bank, which reported results that have been well received so far this morning. Our next guest has been a longtime investor in National, Barry Schwartz, frequent guest here on BNN Bloomberg, Chief Investment Officer and Portfolio Manager, Baskin Wealth Management. Barry, great to see you. Thanks for the time as always. What was your takeaway on what National had to say?
I was reading through the report. I haven't obviously listened to the conference call yet, but what stood out, of course, is the terrific results like BMO and BNS for capital markets, just incredible results there, as well as wealth management. You know, National Bank is really is becoming less of a bank and more of a trading and wealth management operation as well. Nice results from its U.S. non-prime loan business, as well as its largest growing bank in Cambodia. So interesting there. I guess the one offset, of course, is the rise in provision for credit losses. Great interview, by the way, with Scott Thompson from Bank of Nova Scotia. And I think National Bank is probably echoing the same. Just the worries about the tariffs, the uncertainty means that you should be prudent about credit losses or provision for credit losses for 2025. Anything can happen. We have no idea if there's going to be tariffs on March 4th or April 1st or what have you.
Yeah, and you know what's interesting is that if you're a bank and you're based here in Canada and you're trying to navigate those headwinds and you're looking for opportunity, big opportunity, what are your options? Now, we have over the last couple of years seen some sizable transactions, whether it was RBC's deal with HSBC or National with Canadian Western Bank. I remember, I think I was talking with you shortly after the CWB deal was announced, and I guess just because of the size of it, there was some initial weakness in the stock, which you really discounted as a long-term investor. Give us a sense on what that deal, the Canadian Western Bank deal, do you think ultimately allows a national bank to do?
Well, you just have to go back to your interview with Scott Thompson, where he talks about maybe a change of tone in Canada, increasing oil and gas infrastructure spending, LNG, more pipelines, adding more data centers in Alberta. What better place to be than having a bank doing cash flow lending in Alberta and BC, right? So Canadian Western Bank, a great acquisition. They'll be a tough job this year integrating that into their numbers. So it's really hard to tell if National Bank's earnings are going to grow from here because there's going to be a number of costs involved. But long term, this is an excellent deal. Over the long term, National has been terrific operators. All the acquisitions that they've made, they have been really home runs, whether it's the Cambodian growth, the acquiring the TD Waterhouse institutional business, growing their wealth management business, as well as Credigy. So National has a terrific track record of acquisitions, and Canadian Western Bank really underperformed for many, many years. Hopefully the tide will turn for them.
All right. I want to switch gears, Barry, just to the broader market tone, because you're a long-term thinker. You're somebody who likes a bank like National, but you also have generally leaned into a lot of big technology companies. Things have felt a little iffy in the markets more recently for like a whole host of reasons. Maybe it's just the fact that stocks have had a nice move already. Maybe it's the fact that we're in February, which is not always the kindest month to stocks. But what would you say to people who have seen things looking a little wobblier out there and they're wondering what the future holds for equities?
Well, we've been telling clients, and you really just hit the nail on the head. Valuations are at high levels, right? So a lot of the growth over the last few years has been people paying more for stocks, and rightly so, because they're great results from the Magnificent Seven and a lot of other high quality names. But given the size that they are now, the growth isn't going to be like it was in the past. These kind of stocks are not going to grow their earnings 30 or 40% anymore. They're not going to compound by those levels. So as a result, the earnings growth is still going to be good, but it's going to slow down. And so the multiple expansion that we saw, we think, is over. So now it really has to come down to, can you pick good quality companies that you think will have double-digit earnings growth? We think we can, but everyone should expect that their performance going forward will be a lot more muted than the last 5 years. I think the last 5 years, the S&P 500, 17% compound rates of return, that's not normal, and that's going to normalize over the next 5 years. Okay,
Barry, great to see you. Thanks, as always, for great perspective. We appreciate it. Barry Schwartz joining us with his take on the markets and, of course, on National